I was hoping you guys weren't expecting me to come in a suit or anything like that. I'm Brent Benston. I'm the CTO of QTS Data Centers. QTS is the largest global data center provider on the face of the planet. So we're building 16 or so campuses around the country at this exact second. We're doing some of the most advanced computing inside of our buildings. When you hear people talk about the cloud lives in our buildings. Our customers need access to some of the largest networks in the world. When this AI thing becomes terabit, how do we go deliver the infrastructure for that? We need a partner that can match that scale. Lumen, at the end of the day, is one of the largest, what we would consider a tier 1 carrier. A really reliable, really robust, technologically advanced network, breadth of services, totally differentiated, specifically in metro interconnect world. We think of it as one of our premier partners in the ecosystem. It's that one stop that our customers can come and get a complete assortment of services. A hyperscale customer who has terabits worth of network needs, you can go do that with Lumen. If you're a smaller ISP and you need private networks, you can go do that with Lumen. The measure for us that's super important is how much of our customer demand we can meet with one provider. And I think that's where Lumen steps to the top. So the products specific to Lumen are driven by the high bandwidth needs we have for these AI workloads. It needs to be reliable, needs to be secure. Everything from the 18 buildings worth of direct fiber access, wave-based technologies that we use. We are also a big believer in network as a service. We tap into Lumen's private connectivity fabric. Those are the types of things that drive us back to the Lumen network.
We're thrilled to welcome to the stage Lumen's Chief Financial Officer, Chris Stansbury.
Good morning, everybody. Nice to be with everybody today. When Kate opened, she talked about drawing a line between our past and our future. And as I sat watching the presentations this morning and as I look around this audience today, I can't help but take a little walk down memory lane back to April of 2022 when I started at Lumen. And there's particular faces in this room and particular moments that will be forever etched in my mind when I got what they call candid feedback. And when I think about our past and our future, I think about two words. I think about trust and I think about opportunity. And we're going to talk about both of those things today. I'm going to focus first a little bit on the past. And the reality is we had to earn your trust. And we have to continue earning that trust. But how do we do that? We had 4 objectives. The first was to return the company back to free cash flow growth. There was a crisis in the company. It was debt, and we're going to talk about that and unpack that a little bit more. But we had to show that we could get back to a future that had solid free cash flow. And we saw the opportunity in both digitizing the network, but also in PCF. And that's really what started to unlock our future. The second was, and I just touched on it, we had to transform the capital structure. The capital structure, sadly, was the story. That's all we talked about. And I'll unpack that a little bit more in a minute. The third thing, got to get EBITDA back to growth. We committed to making that happen in our guidance this year. And that's really driven by our modernization and simplification efforts in the near term, but then longer term, the PCF revenue coming into the model and the growth of our digital and ecosystem platforms. And then lastly, we've got to return to revenue growth. That's going to take a couple more years, but there's really favorable tailwinds, and we'll talk about why our confidence in hitting that number is so high. I'm also going to give you the answer on what you need to watch for, because there's some really simple assumptions in this that we've made, and there's only one big one. And I think the upside there is more significant than the downside, and we're going to show you that today. So how did we transform the capital structure? Obviously, those PCF cash flows gave us fuel, but we entered the market at the beginning of last year, and over the course of the year, we did 6 transactions touching $11 billion of our debt structure. This is before the sale of the fiber to the home business. We sold the fiber to the home business to AT&T, as Kate said, paid down $4.8 billion of highly restrictive super priority debt. And the combination of those two things reduced our interest expense burden by almost $500 million. Again, more fuel. That lowered our cost of capital. As Kate touched on, our bonds are trading at all-time highs. And our job is to earn a return greater than our cost of capital. Kind of hard to do when your cost of capital is north of 20%. So we had to get that fixed, and we did that. What we're seeing as we go through the simplification efforts on our debt structure, we've eliminated about 40% of the tranches that were out there. We're getting more covenant flexibility, ratings upgrades are starting to happen, and now we're in that cycle where we should see continued lower cost of capital, more opportunities for us to refinance, et cetera. This is the last time I want to show this slide, but I think it's important. The upper left was the existential threat, right? When I arrived, when Kate arrived, we were looking at a situation where $20 billion of debt, that was a thing, but the real thing was almost half of that was due in 2027. And you all know the storied history that we went through as we renegotiated that debt, which had a lot of complexity behind it. That didn't fix the problem, it bought time. And I'm going to remind you that many of you, frankly, many of our advisors, a lot of the media said, why on earth would you go through all of that effort? And the reason was, we knew that there was underlying demand for this incredible asset that has been in the ground for a quarter of a century. And that was our ability to deploy PCF. We had the ability to sell the hyperscalers the one resource they don't have: time. Because we could deploy those networks faster than building their own. And had we gone down a different path, had we gone down a path like many of our predecessors in the industry and said, we're just going to go through a Chapter 11 kind of restructuring, we wouldn't have capitalized on what at the time we thought was a $12 billion opportunity. And as Kate said, to date, we've delivered 13. That's why we did it. And now we're in a position to go digitize the industry. The impact of the refinancings I talked about, the lower left or lower right, is where we sit today post the sale to AT&T. We're looking at a normal capital structure with normal maturities and a leverage ratio that's below 4. So we're here, and I think we can stop talking about this now. So where do we go from here? There's a few more things we can do. We're actually actively engaging in conversations right now to put a new revolver in place. That's just normal course of business. We will continue to focus on collapsing the number of debt silos and reported entities so that we can simplify the way we report to you, and so that what you look at and how you look at evaluating the company is exactly the same way we're managing the company. And then lastly, as EBITDA continues to grow, we will see continued deleverage, and we'll look for opportunistic ways where we can further reduce debt. So all of that really results in a near-term leverage target of 3 to 3.5 times. We're at about 3.8 right now. And the good news is that I think the objective we set for ourselves, which is a really boring balance sheet, we've achieved. Boring is good. And so now we can pivot to the future. All right, where do we go from here? You've seen a lot today, and I want to get into why the economics that stem from that strategy are so compelling. The PCF builds and the scaling of digital, combined with what we see in the legacy business that continues on a dollar basis to get smaller and smaller, are huge tailwinds and give us enormous confidence in that inflection back to revenue growth. Our capital allocation around that, we're going to go through in a little more detail today, but what that results in is higher margins and lower capital intensity, better free cash flow. We're going to continue to focus on our modernization and simplification efforts, and I'll jump into that in just a second. And then free cash flow generation, as I said, is going to be what really is the result of all of that. So on modernization and simplification, remember last year when we gave our guidance, we said we thought we would do $250 million as we exited 2025 and are on our journey to deliver the $1 billion that we committed exiting 2027. We delivered 400 last year. Our target for this year is 700. We're still targeting the 1 billion and are highly confident in that for 2027. But what I really want to focus on here is this isn't just about the dollars. This is not a traditional cost out program. This is truly about getting into the DNA of the company and fixing things that have accumulated over decades. This is about eliminating IT systems. It's eliminating real estate. It's consolidating to new and modern platforms. It's about using AI first in how we manage ourselves, and there's savings that results from that. But the big outcome is focus. The amount of effort that goes into trying to keep software alive, where the people that wrote the code have long since gone, and there's really no support left, it's enormous. And so every passing day, we're seeing more and more focus on the enterprise vision that we've laid out. So let's talk about Capex. We talked about the physical, the digital, and the ecosystem, but underneath all of that is basically the stuff I just talked about. There are some things that have to be fixed. Phase 1 of our ERP went in last year. Phase 2 will be going in a few months. We've got to do CRM. We've got to exercise against and execute against our North Star vision for IT, a much more simplified, modernized IT structure. We also still have a lot of success-based capital. We're still selling the old way while we pivot to the new. And so that's about half of our total Capex. That layer, that foundation, is about $1.5 billion. PCF, another $1 billion. We've talked about that a lot publicly, and it's going to stay at that level for a while, and I'll get into some more detail in a second. The rest of it, the $500 million, is really going into what we talked about today. That's the expansion of things like Rapid Routes and Metron and DC to DC and Cloud Connect. But it's also about developing the digital layer and in the ecosystem layer. We promised we'd give you some visibility on PCF. Here it is. And we're giving you ranges for every year because we know what the numbers are. And we know what the numbers are because we're only sharing what's been contracted. We have been very consistent in saying we are not going to forecast PCF cash inflows based off of a deal that we might or might not get because they are really big and they're super chunky and they're hard to predict. So what you're going to see as I close out with the economic model today is the assumption that we don't sign any more. That's upside. This is just what we've signed. And so what you see is the cash inflows, obviously front-end loaded. And for those of you that have already started your modeling, I see you, you're going to say that doesn't add up to 13 billion. So I'll give you that answer now. It doesn't add up to 13 billion for two reasons. There were some inflows on the builds in 24. There will be some more inflows post 30 on the builds that are contracted. And then don't forget, roughly 10% of the contract value is for operating and maintenance, really over the remaining 20 years of those contracts. And that'll obviously, be a huge piece that flows in after this time period. Capex lags those inflows. You've got those estimates here. Again, big, chunky. It's going to bounce around quarter to quarter. Last year, we were answering a lot of questions about whether we were going to come in under our Capex guidance. There was obviously a lot of Capex in Q4. That's this, right? That's what drives this. And then revenue's pretty simple. We know what the construction schedule is. And as those routes get delivered to the customer, that's when the revenue starts to get recognized. It moves off the balance sheet and into the income statement, and that's what you see here. So we've said that we expect to be between 400 and 500 million in 2028, which is what you see here, and we would expect that with the recent signings to go up to about 550 to 650 million by the time we exit 2030. Okay, a quick refresher. Part of the very candid feedback that many of you gave to me when I first came into Lumen resulted in this thing called Grow, Nurture, and Harvest. And that was our best attempt to give more visibility to the market into what the heck was going on inside of enterprise. And it's served its purpose. It really has helped us. It's allowed the market to track progress over the last few years, but it's also come of age. And it's time for us to simplify. And so really since the end of the third quarter last year, we've been talking about this. This is a map on how you get from grow, nurture, harvest to strategic and legacy. And what we did is we went one layer deeper. We said, rather than saying all waves is grow, well, 1 gig waves isn't grow, right? That's moving more into the legacy bucket. This is finally about taking a product lifecycle mindset to the way we manage the company financially. And so we pulled those 1 gig waves out. The same is true in the other direction. Not all Ethernet, which sat in nurture, is in decline. Ethernet on demand is a huge growth opportunity for us as we move to more software delivery and the digital motion. So that's what we've done here. And coincidentally, you get to a place where strategic is about the same size of grow. So now, one of my favorite charts. This is just gravity. This isn't big assumptions. This is saying if we take what we sell today and we grow or decline it with market, and we layer in only what's contracted under PCF based off of the delivery schedules that we are meeting with our customers today, and we layer in digital, this is where you get. And the reality is mix is finally a tailwind. This year, strategic is going to be over half of what we sell. And by the time we get to 2030, because of PCF and because of digital coming into the model, and because of the absolute dollar volume of our legacy business declining, we get to over 70% that's strategic. And by the way, that legacy business isn't a bad thing. That's cash. That's what's allowing us to invest as aggressively as we are in our digital future. Okay, digital. Let's talk a little bit about what's in digital. It's the first time we're disclosing a number here today, $117 million in digital in 2025, in digital revenue. As we said, we want to get to 500 to 600 million by the time we get to 2028. Pretty good start. What do we know about digital? If you look at this shift to a consumption model across other areas of tech, all of them have experienced J-curve growth at one point or another, where you've got steady growth and then you hit an exponential curve. We think that'll play out here. We don't know where that is. So what we're not projecting, as I get into the numbers in a minute, is a J-curve. We're projecting linear growth. That's upside. What do we sell today? We sell infrastructure services, which is really edge, fabric and fabric ports, connectivity services, that's where NAS sits, communications, security. But what I really want you to focus on is the right-hand side, because this is where, if you're really interested in the Lumen opportunity, forget about revenue. You have to ground yourself in adoption metrics. Because if we drive customer adoption, we get more customers. They land and expand and consume. We get more ports. We get more services. The revenue will come. That's what ultimately leads to that J-curve moment. These are the things that we've been tracking. These are the things we've been talking to the market about for a number of quarters now, and we will continue to do so. So as Kate said, we sold a lot more than 3,800 ports. Now, some of that are redundant ports, because wherever you have a port and a lot of services on it, you're going to want redundancy. But some of it is ports that have been sold that haven't been installed yet. So this is moving very rapidly. And while this doesn't look like a very big number in terms of services, the same thing is going on there, right? Services haven't been deployed yet. And in the example that Kate showed of the engineering firm and how they've grown, we're seeing more in the 3 to 4 services range today. Obviously, there's the ability to grow that as more and more services come online. I do want to do one housekeeping thing, though. One of the competitors that provides this service kind of on top of networks, Ryan talked about earlier, they count the numbers differently. They assume the port, including a redundant port, is a service. So it inflates those numbers. The way we're looking at it, we're really trying to give you transparency into this. The port is not in the service count. These are software services that are delivered on top of those ports. And here we are. P times Q math. And if I were to use one word to describe this chart, and boy does it feel good, optionality. Haven't had too much of that in the past. And what it's showing you is that we have multiple pathways to get to $600 million. If you look at the assumptions that are underneath each of these scenarios, the key assumption is really the amount of north-south versus east-west traffic. And I want to drill in a little bit on something that Jim said earlier. That north-south bucket isn't growing in dollars. You know what is growing? The amount that's being consumed in that bucket. So what is that? That's the old enterprise telco feedback that we've gotten from many of you around, but it's a commodity. As fast as volume is growing, price is falling. That's north-south. The only north-south value added that really has existed in the marketplace is what we've been able to do with PCF. East-west is where the gold is. That's where the growth is, that's where the margin is, and as Jim said, there's a huge opportunity that as we capture more and more east-west traffic that we can capture more share in north-south. So what you're seeing here are 4 different scenarios. The first scenario is what's in our model. We picked one. And the reality is we will go where the market demand goes. If there are 2 attributes of Lumen that I admire the most, it's the fact that we are nimble and we're agile. And we go where we need to go to execute. How we got here isn't necessarily what we thought the plan was when we started all this. And the same will unfold here. So we'll deploy our resources where we see the market moving. And again, the opportunities here are huge. Really important number. Okay, look at these number of ports. You see somewhere between 20 and 40,000 ports. What is that as a percentage of the total footprint that Lumen has today, excluding TDM? That's a low single-digit percentage of our network today. So what am I saying? I'm saying the opportunity for scalability here is huge. Okay. Let's talk about the key drivers of our long-term growth algorithm. I've already touched on a lot of this. Digital revenue, 500 to 600. We've talked about that by 28. That obviously grows by the time we get to 30 to more like $800 or $900 million. PCF revenue, just touched on that a few minutes ago. Growth businesses in the base grow with market. Legacy businesses decline with market. What you see happening within strategic is that PCF early on gives us a boost in terms of revenue, but it's really digital that is the bigger opportunity as we go forward. Both of those have upside, as we talked about, but digital is really what becomes the growth driver for the company over the long run. All of this leads to better margins, both PCF and digital. And PCF, if you think about what we've done, we've invested significantly in a fixed cost base to go deploy these things. So as more and more of that revenue scales into our model, you're going to see operating leverage benefits, which impact our margins. And digital, obviously, as we've said, no truck rolls. On demand, quicker time to revenue. All of those things help our margin structure. Okay. So here's the algorithm. And what you'll see is our revenue growth, last year we were down about 4.5% in the business segment. We expect that to moderate a bit this year. We guided that. In 27, it's a much more significant impact. And it's a more significant impact because we see digital scaling, because we see the deployment of those PCF builds scaling. We hit inflection in 28, and then we think we'll get to kind of low single-digit growth thereafter. EBITDA margins rise substantially. from the mid to high 20s right now to the mid 30s. We're very confident in that. Cash interest stays about the same. And our capital intensity ex PCF, why ex PCF? Because PCF isn't capital intensive. It's paid for up front. Ex PCF, our capital intensity goes down by 25%. So significant impacts. Now, let me tell you what isn't on the page but is in this model, because it's really important. Everything is funded. Everything. What do I mean? It means all the capital that we need to invest to fix that foundational layer and get our IT environment cleaned up. It's everything that Jim talked about that we're building physically and digitally. It's PCF. It's all funded. What else is in there? Things like pension funding requirements, all funded. Okay, what else? All of our tax liabilities. And we're assuming that as debt matures, it's paid down at maturity. Now, whether we do or we don't, that's obviously a choice point at that time, given market conditions, given where our leverage is with EBITDA growth. But right now, the model assumes that. Why am I saying it? Because when you model all that out with those assumptions, you're going to get to a remainder that's positive. This business, after all of that, if you model this out, is generating free cash flow after all of those items. And so what are we going to do with that? Well, as leaders of the company, we have a responsibility. The first is growth. And so we'll invest in organic growth first, always, where we see a return. Second, inorganic growth. If we see an opportunity to acquire something that furthers our vision and accelerates our ability to convert to a digital consumption model, and there's a return in that for shareholders, we'll do that. The third thing, we'll continue to manage our capital structure really efficiently. And after all of that has been exhausted, if there's something left, then we'll consider share repurchases. Okay, we're going to finish where we started. We've covered a lot today, and I want us, to go back to where we started, which is our strategy. And I think the most important thing is we have turned a page on our past. This is not the Lumen that we walked into. This is not the Lumen that I got all that feedback on, right? And we couldn't have done that without the team that we have and the culture we have. And quite frankly, I don't think too many people thought we would be here today. So what truly differentiates us, that physical network, the digital model that we're building, the ecosystem partners, this isn't a legacy telecom anymore. We're a digital network services company. And that's why you need to change the way you think about modeling, because it really is all about those adoption metrics. So, how would I summarize it? The first thing we had to do was disrupt ourselves. Now we're ready to go disrupt an industry. So we're going to go to Q&A next, but first, a quick video from some friends up the street.
I've always been a Babe Ruth fan. The house that Ruth built was originally Yankee Stadium. I've been with the organization for 20 years. I'm Mike Lane. I'm the CIO and Senior Vice President of Technology and Broadcasting for the Yankees. Digitally, we're a world-class organization. We have to develop a world-class set of systems. We're excited to partner with Lumen. For us, it's all about unlocking that smarter, faster, more resilient digital foundation, supporting more content, more venues, continuous audience growth. The scalability is huge. Lumen's massive fiber backbone is huge. Having a secure environment that you can trust, a cloud-first provider, is one of the first checkboxes on the list. We're exploring Lumen's network as a service, internet on demand, Ethernet on demand. This will allow me to scale on demand, only pay for what I need right now. Ethernet on demand gives us the fabric we need to tie all of our venues together, from our data center in Tampa, Florida, our spring training facilities, our player development, to Yankee Stadium. I'm confident that the Yankees-Lumen partnership will show what's possible and a modern, data-driven enterprise. You can take pictures with her. You guys want to do it?